And yeah, let's I don't know where Pablo is, but I think we should just start.
All right. Well, Micah, first of all, share some hair with the rest of us. Good grief. I love that.
Looking good.
Jealous.
Fresh
Um,
cut.
very nice. Well, I'll tell you what. So I struggled with tonight in a good way is when it comes to trading, specifically investing. So we're going to have a little bit of a hybrid conversation tonight. I think I had mentioned last time, in my opinion, and you're going to hear me say that a lot tonight, in my opinion. And the reason I say this is I was talking with Miko here earlier. My life and my friends are all in the trading community just because of the people that I hang out with, and everyone has their way of approaching the market. So mine is unique to me, right? And that's what makes a market is different points of view, bulls and bears for long-term, short-term, midterm. So that's what makes a market, and that's what makes it jump around like it does. But at the end of the day, it's about developing your system and understanding that if you do have a system, and I'll show you with tonight my system, which is actually pretty, in my opinion, pretty easy. You can always make it more complicated, which I tend to do. But if you have a system, it becomes more mechanical. I think too many people approach the market as if it's so complicated that where do I get in? Where do I get out? Do I take the hot tip from CNBC or Bloomberg or the cab driver, whatever, my friend? It doesn't really matter. It just sometimes seems all encompassing that we don't even know where to start. And I'm here to tell you, it's not. It's very finite. It's very easy to understand. But I also want to be very clear from the get-go. And I'm going to share a slide here in a moment that probably is embarrassing to me, is don't ever approach investing as immensely as if you're going to win every trade. You're not. Statistically, that's improbable and impossible. And I think what I've seen is where investors or traders get burnt out, or rather lose a lot of money, is they get what we call FOMO, fear of missing out. And they chase things with no specific reason, no specific thesis. But they don't have a system in place, right? They don't have rules in place. And I'm here to tell you, I'll teach you all my rules. I don't care if it takes all night, 2 nights, 3 nights in a row. We can do this as much as you all want. There's enough, market share to go around. It's not going to run out. But the point of it is we need to develop our rules, stick by the rules. And even I've been doing this for so long that even today, I broke some rules, lost some money in a day trading. I'm in a small account challenge with a few folks. And I got too excited because I was up 50% in the last couple of weeks on the account. Most people are happy with that for a year, much less, and so I was happy with that. And I got like everyone does, greedy, and I'm down about 20% this week. So rant. But the point of that is I broke some rules in doing so. But the point of it is that's day trading. But when it comes to true investing and swing trading, which we're really going to talk about more tonight, though I'll delve into any topic you guys want when it comes to the markets. It is about consistency. And when you understand the stats, meaning that, look, here, let me share something. And Miko, you keep me honest. If I'm sharing the wrong screen, let me know quickly.
Yeah, of course.
I think this is the one. All right. Can you see that one?
I think it's coming in a second. Yes. This is the one you were showing me earlier, right?
Yeah.
Okay.
Yeah.
Yep.
All right. So the point of me showing this, and I have a whole slide deck here. But this is I have multiple accounts. I have a day trading account, a swing trading account, which is what we define as holding an investment overnight, over days, over weeks, over months. So again, 3 ways to approach the market: day trading, where you're in and out in the same day, you're at cash overnight; swing trading, which we're really going to talk about more about tonight; and investing, which is more like, hey, I bought Apple and I'm holding on to it for 20 years. And we can talk about investing too. Miko, what I would like to say, and I'll throw it out there now, is if anyone wants me to go down a rabbit hole, type it in the chat. I can't see it. Miko, you keep me honest, interrupt me when you can. But that's why I struggled with tonight, is there's so many directions we can go, right? But I wanted to show these stats first and foremost. This is my swing trading account specifically, meaning the strategy that I'm going to teach tonight, as much as I can. And what you'll see here is I spent years trying to figure it out. It looks like I made $0. I actually made a few in there, but for many years, right? I struggled for maybe 2 or 3 years in there on this type of trading. I was actually a decent day trader, but the swing trading I had a hard time with. But I finally developed a methodology. You could probably figure out where that occurred. And since then, have had a pretty nice 3 years. But don't let this profit margin fool you. Look at my stats, and this is what is embarrassing. I deal with a lot of traders all the time, and everyone will tell you about their good trades, but no one will tell you about their bad. Well, look at my winning percentage. This is embarrassing. I win 54% of the time. You know, if someone told you, hey, yeah, flip up a coin, I may be in a good trade or bad coin, 50-50, you'd be like, not listening to that person. But even with a 54% success rate, I've been able to achieve a pretty decent return on this strategy. And the reason for that is the strategy itself. And from a high level, what that is cutting losers quickly and letting winners ride. So you have to, trading is more about setting your mindset. Do not go into this thinking that every trade is going to be a winner. It's not. But if you really talk to serious investors and serious traders, you're going to find out that most of their profits are similar to this. Even my day trading account is actually around 60-65% winning. The point of that is you're going to have losers. All of us tend to focus on that. And because we focus on the losers, we make mistakes. Here's an interesting statistic pulled from eToro, which kind of tracks all the statistics from their traders. Is eToro found that the whopping 80% of traders lose money over the course of a year at a median loss of 36%. Like that, to me, that's staggering.
Wow.
But the point of showing that is, and this was a follow-up note to that, is what they tracked is that traders sell winners at a 50% higher rate than losers, meaning think of it as groupthink. When we have a loser, when we're losing money, if you all have been trading or investing, the one thing you probably have felt, and if you haven't, good for you, is that, oh man, well, how much further can it go down? Maybe I'll add to that position because it's cheaper now. It's less expensive. Oh no, it's even lower. Well, I can't imagine it goes much lower. I'll buy some more. Well, as we know, and if you haven't been there, I'm amazed because I've been there a million times until I learned not to do that. But the point is that's what we do to our losers as a group think. But for the winners, we tend to say, oh my gosh, yeah, I'm up 20%. I better sell it all, get out, instead of letting them ride. So what we're going to talk about tonight is not only how to identify a winning trade, but even besides the trade, it's more about the structure of the trade, right? At the end of the day, it's about, well, when do I get in? When do I get out? And if you let those probabilities play out over the course of days, weeks, months, and years, it can make a nice growth of your account. So let me pause there first and foremost, because I kind of just threw a lot out there. Miko, do you have any questions? Or are there any questions?
Yeah, I do. So when you say like when you have like a losing trade, would you consider this loss of a trade still like you applied your theory, you applied all your indicators, and it still loses? Or is it
absolutely.
okay?
Yeah.
Or is it like mistakes, and you didn't stick to it?
Very good question. Okay. So number one thing that I use to track all of my trades, and you know what? I'm going to bring this up now. I think you guys might like it. It's a paid service. It's not too much. I mean, well, it's relative, I guess. It's, I think, $25-$30 a month for this. But here, I'll bring this up on the screen if I can. Give me a second. Oh, there we go. Oops. This is my day trading account, but it's a service that I use at the end of the day.
I don't think we see it yet. Oh, here it comes. Yeah.
Okay. So this is called Trading View. And not to be confused with Trading View. There's Trading View, VIEW. I use that too, but Trading View, VUE, it's a service where you upload all your trades when you're trading, and it analyzes it to the nth degree. I mean, when you really get into this, it will break down, time of day, days, probabilities of success based on, all this stuff. But to answer your question more specifically, when I upload my trades, I tag them with a very specific tag, meaning the trade, the pattern that I was trying to trade at the time. Now, if I enter into a trade because I'm being greedy that day and it literally had nothing to do with the trade, I will actually tag it as NA, meaning non-applicable.
Hmm.
And so what's important about that is, as an example, then I can filter my trades up here. Not to be a promo for this website, but I'm going to show you how embarrassing, my greed can be, right? Here, I just typed in NA, I typed filter. These are all my NA trades. Well, gee, I wonder how much, how much has that cost me over the years by not following, but not over the years. This is my small account challenge. Well, you can see in my small account challenge, this has cost me almost $15,000. Now that's okay because we're still profitable in the account. But my point is this: if I would have followed my rules on every trade, I wouldn't have lost that amount.
Hmm.
So to answer your question is, whenever we're investing or trading, I don't care if you do it shorthand or on Excel or use some sort of software like this, it is important to track yourself on if you're getting in, why. So Miko, that then brings me to my first point for tonight, but does that answer your question?
Yeah, yeah.
Okay.
Micah also had a quick question.
Yeah.
A
Okay.
win is he saying a win is considered taking any profit? Question mark. Bought
Oh,
lower than sold? Question mark.
good question. Good question. All right. So I want to make sure I'm answering that question properly. Is a win considered taking some profit? Meaning, if I took some profit, but the rest of it lost, would that be considered a win? And the answer, if that's the question, the answer would be no. Meaning, a win for me is that when I'm completely out of those shares, when the trade is complete, that I'm profitable. Does that make sense?
Yeah, I was just looking at those stats that you had up there, win and loss, to see which was what a win actually meant. Okay.
A win means a profitable trade.
Okay.
Even if it's a part of, so yeah, so we're gonna walk through that here. And again, I'm probably gonna be a little bit all over the place, but I'm gonna try to keep it succinct.
All
And
good,
then
man.
I think we'll use the Q&A afterwards, and I'll stick around forever to go down any rabbit hole we will. But
Awesome.
let's start back at the top of this. Well, maybe not the top, but okay. So I know Pablo was telling me that you all had talked about technical analysis, at least to some point, like candles, opening and closing. And we're going to look at a lot of that tonight, which is really fun. I mean, at the end of the day, that's what we look at. But why I brought up a dashboard is simply this. In the beginning, when we look at technical analysis, and I remember being there, I really do. You look at it and you're like, oh man, I guess maybe I understand the concept, but I don't know. Like, this is kind of crazy. Well, it's no different than the dashboard on your car. It literally isn't. Like when you get in your car, hopefully, you turn on the dash, and if there's any warning signs, hopefully, not all of us do, but hopefully you're taking heed, right? They're just indicators at the end of the day. When your fuel gauge, it's merely an indicator of how full or empty your tank is, right? And I'm saying basic things, but I'm driving a point home that's going to be very important when we come over to the stocks. If you're driving manual, RPMs are very important, right? And so it's just a measurement of when you should shift gears. That is absolutely no different, right, than when we're looking at the stock market, where you're measuring technicals to put the odds in our favor. You will never find a technical that gives you 100% accuracy on when to enter or when to exit. But what it is sharing with you is this stock worth buying? Is it overpriced? Is it underpriced? Well, let's start there, right? Let's answer some basic questions and take yourselves off mute, or Miko, if you can, we have few enough people here. I think we can actually have just more of a group forum, really.
Yeah, absolutely.
I'm gonna ask basic questions, but I think it's just powerful to hear it out loud. Do you want to buy a stock that's overpriced or underpriced? Yeah.
Underpriced.
Under.
Exactly. These are obvious things. But how do you know that arbitrarily? You wouldn't unless you had an indicator to tell you that. Well, there's several indicators to do so. My favorite one is the MACD. Now, did you guys cover the MACD last time, right?
Yeah, we did. Yep.
All right, good. All right. So I'm gonna start from a very bare bones example. Before I do, I thought for tonight, what might be nice is to actually approach this as if I were entering a trade. But I'm going to start from a very high level, and then we're going to drill down. And what I mean by high level is I'm going to start as if someone was just saying, like, I don't even know much about investing. I understand there's these things, maybe candlesticks, great. But even that, I don't understand. I have money sitting in a bank. I've never really participated in the market. How would I even start? So let's start from that level, and then let's drill down to even much more complicated stuff this night. Sound good?
Yep. Great.
All right.
Perfect.
All right. All right. And I do mean this. Please feel free to interrupt me on anything. Meaning, hey, even back up from there. Like start like, what's a stock? I don't mind. You know, I really don't mind. I'll be happy to entertain this. So let's start from what I'm looking at right now. Can you all see the stock screen?
We got it.
Okay, great. Does anyone have questions on candlesticks before I go through this? Okay.
I have a question. What tool are you using right now that you're showing?
Oh, good question. So this is E-Trade Pro. It's my trading platform that I tend to use. Don't tell Merrill. I actually work for Merrill as an investment advisor. Don't tell them. I don't like their platform. It's terrible. It's
Really?
It's horrendous. It's not meant for trading per se. But yeah, this is E-Trade Pro. You can use, I would say the top two trading platforms that I prefer, just my opinion, is TD Ameritrade and E-Trade Pro. Not to be confused with E-Trade. E-Trade Pro is the downloadable software that you actually have to call them for. It's free, but you just have to call them to get access for some reason. Does that answer your question?
And why do you prefer it?
Just the amount of technicals and overlays.
Okay.
And honestly, if I was truthful, I probably would like TD Ameritrade's Thinkorswim downloadable platform more. But I used this for so many years before I found TD that I just got used to it. Right. At the end of the day, it's just the entryway to get to what I want to do.
Totally.
All right. So let me bring up a couple things here. So did you all talk about moving averages last time, or when you all spoke?
We did. It might be good to kind of go over that again, maybe.
Yeah, I think we can review again.
Yeah.
Also, I just want to mention real quick that Ari, a lot of the indicators that he's showing are also available in Trading View, except maybe that volume profile one is like a premium feature on Trading View. So I think that's worth noting.
Yeah,
it is. You know what? Let's go there because that is. I want to try to do. Oops! I always go to the wrong. Somehow I misspelled it once, and then it takes me to spam websites. Let's use Trading View because I want to be able to. I want you all to be able to replicate exactly what we're doing.
Thanks, John.
Yeah. This is Trading View, right? Yeah,
that's it. Alex Honnold.
And listen, I know sometimes I can be as exciting as listening to the paint dry on your walls, but you know, if you bear with me, yeah, I guarantee you, at least you'll walk away with something here. So,
well, I got some ace.
All right, well, we're not looking at ace, so sorry about that. All right, so what we're looking at right now, I'm going to clear off a couple things. I always overlay lots of different strategies, but all right. So what we're looking at right now is the SPY, which is the proxy for the S&P 500, which is the broad market, right? When we hear the market closed, you're hearing different indices. Specifically, I like the S&P 500. That's probably a different conversation for another time. When you bring up a chart, you want to have it in candlestick form. I understand that you all know a bit about candlesticks, or at least some. It is important to overlay indicators that will help us, like a dashboard on your car, to understand, is it overpriced? Is it underpriced? And where is momentum going? No different than, hey, do I have fuel in the tank? How far can I go? When we look at things like the MACD or relative strength, that literally is our gas tank. It's telling us, wow, this thing is really oversold, meaning think of a spring. It's really compressed. This thing may have a lot of energy and could really go far. It's no different than saying, wow, I got a lot of gas. I got a pretty good gas mileage, depending on the stock. I think this thing could go really far. So that's why indicators are important. So you're going to want to, first and foremost, make sure you have the MACD. It stands for moving average convergence and divergence. Not important. Then what I would tell you to also bring on, first and foremost, because we're going to start high level, as I talked about, is you're going to want to bring in the 200-day moving average. And if you have questions on how to use Trader View, maybe Pablo, that's something for you all another time. But if you're writing things down, it's more important to me that you understand what we're talking about, not necessarily how to do it, because that can always be another conversation, which is not a problem. All right. So what we're looking at is the S&P 500, specifically the SPY. This red line is the 200-day moving average. So what is a moving average at the end of the day? Well, it's actually quite simple. At any point in time, wherever you put your mouse, that dot on that line represents the average price of the last 200 days, i.e. the 200-day moving average. Okay. Now, the 200-day moving average, that's what it is. But how does it function? It's a very self-fulfilling prophecy. Okay. Institutions on Wall Street, make up over 80% of all trades in the market.
Wow.
So I hate to say this, if you're looking for like, hey, I'm going to discover something new, there's nothing new. Is if you really just learn about what the masses, meaning Wall Street, are using to watch for big trades, then you just ride the coattails. At least in the beginning, you do. And the 200-day moving average is a very important moving average for all individual stocks, but specifically for the indices. Now, let's start really, really, really high level, and this will be pretty quick. I'm going to zoom really, really far out. There's a stat that's very loosey-goosey, but in essence, the stat says that the market is heading in a northern direction about 90% of the time, give or take. And so what's interesting about that, let's just say you were brand new and you just had money that you wanted to put to work, because Lord knows we are not getting anything from our bank accounts these days. But inflation last month was 5.4%. So we're losing money. We don't see it in our bank account, but we're literally losing money. Well, here's a neat little cheat. And I tell clients this all the time. So, it's not like we keep it a secret. Is if you were looking just to make money, maybe your goal is not to beat the market. Maybe your goal is not to, whatever it is, but just to make money safely on the money that's not doing anything for you. Well, here's a little cheat. Buy a stock, or specifically the index. And when you cross above the 200-day moving average, buy SPY. Not financial advice, not allowed to give that. But SPY, again, what you're doing is you're buying the index if you buy SPY. Now, why would we do that? Well, because institutions view the 200-day moving average, if you're above it, as bullish and below it as bearish, meaning we think it's going down. How would that have worked out for you? Well, let's just take a look all the way back from when we crossed it. Now, don't get me wrong. There are fallacies to this very easy concept. You can have taxable consequences over time. But if you're just looking to make money from a very simplistic point of view, let's see how this turns out. Well, we can go back as far as you want, but for time's sake, let's go back to 2011. We had dropped underneath of it, this 200-day moving average. Up, we popped above. You would buy. Where is that? January of 2012. So we buy. You know what? This is a pretty lazy man's way or woman's way of doing things, because that was January of 12. When do we drop underneath of it? Not until November, the end of that year, and very briefly. So you could have got out and got in. Now, again, I want to make this a caveat. That is terrible for your taxes, okay, to do this. But again, paying taxes on gains versus not making any gains from bare bones. As I talked about, we're starting very high level. Not bad. It's like saying, well, I don't want a job because I don't want to pay taxes, but you want money at the end of the day. Okay, well, let's continue on. All right, you drop below for only a couple of weeks. You're back in. You're back in. Let's see, where was that? That was November. You're back in. Oh, we drop below 2 years later. I mean, come on. Talk about a lazy man's game, right? 2 years later. Now for taxes, that's totally fine because you're over a year. And remember, when we got in all the way back here, the price was 126. You basically got out and in at the same price. So no loss there. You basically got in and out of the same price here. And at this current time, we're at 193. All right. This is a pretty big percentage move. You know, what's interesting is most clients, not of mine, most advisory clients who have financial advisors don't even keep up with the indices, because they say, oh, we need to diversify amongst stocks and bonds because no one really knows what the market's going to do. Okay. There's some validity to that. But if you just followed this simple rule, you would actually do better than the average long-term investor. this simple rule. Not even looking at MACD yet, guys and gals. But we can continue on, right? This is 2014 October, you're back in, you're in now 2015, and you drop under. Now, I'll be the first to admit, this is a lot of chop in here. 2015, we had troubles with the US dollar, which created this chop. So you would have been out in August of 15, back in October. That's still, June, July, August, September, October. You're out for 2 months. You're back in. You kind of chopped around for a little bit. Hey, a little bit of headache every few months for a course of a couple years of not trading at all, not a big deal. All right. And since there's not big swings, there's not going to be big taxable consequences. It's just a matter of maybe every other week you have to get in and get out. And you're not even, you don't have to get all the way in and all the way out. This is just showing you the concept at the end of the day. Now, I'm not saying that if you did get in and out, that's probably not a bad idea either. Anyway, 2015 worked its way out. You finally got back in here. And if you'll notice, at a lower level than you actually got out, and we would have ridden that. There's a few caveats in there, but basically you would have ridden this from 202, kind of jumped around here, but you're already at 260. My point is that's 30% profit again, right? This is the slow way of doing things, but this is for your investment account, your long-term money. And we could continue on. Of course, there's more chop here, but you're basically getting out and getting back in almost where you got out. So yes, I already know, because I get told this by clients all the time. Well, wait a minute, but you didn't buy in at the lows. It's like, well, okay. But if you didn't use this strategy, you would have ridden the lows down and ridden them back up anyway. So don't get me wrong. This is just one high level strategy. And yes, you can improve upon that by dollar cost averaging in and all these other things. But at least what I would submit to you is for your long-term money that you're not trying to swing trade, meaning in and out over the course of weeks and months, your investment money, where you're saying, look, I've saved this money. It's in my bank and it's earning nothing. It's in CDs earning nothing. I'm in bonds earning nothing. This is a very solid way to make your money grow with very little fear of what the market will do. And what I mean by that is, here we go. You will never get the absolute high of the market in the strategy, and you never get the absolute low. This is just about growing your money. You have these wild swings in 2018. I can tell you exactly why all these occurred if you're interested later. We had this, what we call a mini blow off top, but look at this. You would have saved yourself from the COVID drop, meaning, look at this. Back in August of 19, when you've made all this progress from 2009, you're up 300%, by the way, from 2009, 300%.
Wow.
If you followed the strategy. Yes, we had this blow off top. And what did most people do? Oh, man, I wish I would have sold here. Okay. And you would have dropped here. You would have sold at the same level where you were 300% up from 2009 on this strategy. And you would not have had to worry about this additional 30% drop, which was a total of almost 40% drop in COVID. While people are losing massive amounts of money, and I'll tell you, many clients of mine called when we were already down here saying, please sell, I can't handle this. And we're like, no, this is when we buy, right? But the point is this, is this strategy is, if you sold here and you got back in here, you literally almost got back in where you sold. I mean, quite literally, right? And then of course you would be riding it up to where we are. So let me pause there, because that's a very simple strategy. I mean, it really doesn't get any simpler than that, but I wanted to start there. Any questions on that?
Feel free to unmute, guys, if you have any questions.
Okay.
Yeah, pretty simple.
Okay. So again, so pile that, it's kind of funny. Sometimes that's a revelation, right? Okay, really? Now
John,
that doesn't necessarily mean, so I think maybe a follow-up question for myself would be, if someone was showing me this, is like, well, we're above the 200. Should I get in now? The answer is no, to be honest with you. And the
John, I
reason
have a quick question.
Yeah, go ahead.
Yeah, so you're using the 200-day moving average, right, to talk about this, and that's on that S&P index. Does that 200-day moving average make sense for other, like, single stocks? Because this is the whole market, right? So if you're looking at individuals, would a 200-day make sense for certain ones?
Very good question. Yes. The vast majority of large cap companies, specifically, meaning the Teslas of the world, the Amazons, the Facebooks, the Boeings, So let's show this too. One of the myths I like to dispel is that the market is random. There's nothing there random about the market. It's more or less, it's not people on the floor saying buy and sell anymore, right? It's if then statements, if this, then that. Well, let's take a look at this. Here's Tesla, right? Tesla, I'll show you a better way of trading this here in a moment. But if you were to do this 200-day moving average on Tesla, you would have actually had a lot of these gains in this flat area, which doesn't even look like it. But you're below the 200 there. You break above the 200 at $55. You ride that up. Now, we do have a caveat here, right? If you buy a stock for $55 and it's now selling for near $200 and you don't take profit, I've got real problems with you. Now, we'll delve into that a little bit later on how you know exactly when to take profits and those types of things. But all right, let's not get too greedy. If you're up 400%, come on, at the end of the day. But anyway, the point is this did come up. We know this about the 200-day moving average. Most stocks, Tesla is kind of a crazy stock. So it's kind of an exception to the rule, but most stocks like to snap back to the 200. So let's look at this, snaps back. You can't make this stuff up.
Boom,
And when
right
it comes
on
back
it.
to the 200, my favorite trading strategy is this, and it's a long-term trading strategy. I love to see a stock that's taken off, then profit takers come in because you're up 400%, snaps back to the 200, kind of passes over it like you see, and then the day that it closes back above the 200, you re-enter and you recock the gun. And what happened then? You went from $79 to $900. Yes, please. And I was in that trade.
Wow.
And again, let's not think that I have a pre-canned stock. Someone yell out a stock. Let's analyze it really quickly on the same strategy. Not every stock fits this. It has to be a larger cap stock, but yell one out.
You can see it on the MACD too on the Tesla. It's pretty.
Yeah, and we're not even getting into the MACD yet.
How about
Uh,
AMD?
AMD. All right. AMD is a little bit, I like AMD, so let's bring that up. Again, not every company fits this profile, and you'll get some chop around the 200, but the premise is true. Here, AMD, I don't know who said that, by the way. Was that you, Pablo?
Pablo, yeah.
Okay. AMD. Well, when it's starting to move, and these little moves over here don't look like much, but they are, right? This went from, not that you would have been in because maybe this wasn't on your radar, but when something goes from $3 to $15, 500%, that should, at that point over the course of that year, should be on your radar. So what are you looking for? You're looking for it to break below the 200 and then to break back above. So you have to wait some time. I make watch lists that sometimes things are on for a year. I mean, this is a very boring business, but hey, if you want to grow your money, so here we go. We kind of bounce around the 200. Finally, in 2017, we break below. We have a break above. I'm in. Oh man, I'm out for a small loss. Okay, I can handle that. Not a big deal. I'm back in. One small loss, not a problem. I'm back in at $13. It went to $33 that time. Not bad, right?
Wow.
Not bad. Over 100% increase there. Came back down, chopped around the 200. You would have been chopped in and out a little bit. Not a big deal. But my point is showing this is, look how interesting the 200-day average is to institutional investors. I can say this because we use it and we manage, this is what we do. And it bounces. Look, it bounces to the penny. It bounces to the penny. Didn't even go off. Bounces. So if you would have got in, even though you get chopped around, so getting chopped around sometimes is part of trading. It doesn't mean day in, day out, but it can mean week in, week out, or month in, month out for short periods of time. But that's worth it. Why? Because you may have had small losses in here, very small losses. But when you finally got back in at around $20 and there was not even an exit signal, well, if you didn't exit when it reached up to $60, meaning again, another 300%, not total exit, at least taking some profit off the table. There was a small exit, but re-entry literally almost on the same week right here, back at 38. And you wouldn't have got totally out until 78. So again, this is a gross generalization. All right. And I already can hear it. At least I hear it in my own brain. Maybe it's me talking to myself is, well, gosh, how would I have got $100? Why am I selling at $80? Well, wait a minute. I'm talking about money that wasn't even in the market to begin with, right?
Right.
Or maybe you're in a stock that you're up 1% for the year, right? So we're talking about finding stocks like AMD, like Tesla. You want to find stocks, and I'll show you how to do this. You want to find stocks that have the personality of long moves, both to the upside and to the downside. Matter of fact, every stock has a personality that's brought on by the investors that are attracted to it. And the larger the company, the longer the runs go because they're behemoths. It's like a cruise ship versus a speedboat. Small cap stocks, meaning small companies that have little shares, can spike for a day 300% and then crash the next day back to lower than it started. But Boeings and GEs minus some, what we call black swan event, which is just something you can't predict. As long as just a run rate cycle, you can be in these for sometimes months or even years without even getting out. So I could probably beat this drum all night. And I almost kind of want to bring up another stock. Does anyone have just a random stock they want to bring up just to test this theory?
Yeah, I do have a couple questions.
Yeah.
Well, someone said Coca-Cola. But do you have like how many trades are you in at a time, John? And how do you track it? Do you have like a notification system to tell you like, hey, Tesla just broke the 200 going down or going up?
Yeah.
Like I think that can be overwhelming sometimes of like, we all have different jobs and all this stuff. So I bet it can feel like, man, and am I going to have to be like looking at my charts every couple days or every week? Or is
Yeah.
there tools, like what tools do you use to notify you?
Yeah. Very good question. Very good question. So I have Coca-Cola. It's a choppy stock. So let's be honest with that. But you can still use the same methodology on it. But we'll talk about that here in a second. So to answer your question is, I really do feel that as long as I don't bore everyone to death literally tonight, I think this is definitely a several conversation about trading. I mean, come on, I've been doing this forever, and I still learn something a little bit new every day. But the point of showing this is I want to show concepts more than anything else.
Okay.
But I almost feel like we need to have a follow-up that I will touch on tonight, but a follow-up with literally like, okay, if some of what we talk about, if even some of it makes sense, then how do we completely implement this strategy? So this is something, this one's actually really easy to implement, right? We're literally just talking about the 200-day moving average. But something we're about to talk about is a little bit more involved. Yeah, to answer your question, how many stocks am I in at any given time? Well, for my swing trades, which is the strategy we're talking about right here, I like to max it out. Well, yeah, I'll tell you what my ideal is and what I actually do. I break my rules all the time and I pay for it. Is ideally I want 10 stocks at any given time. Why is that? Because on my swing trade account, I invest 1/10 of that account size into a stock. That's how I choose how much to invest into each position. But you can choose your number, right? I just do that because of just how I do things. Now I say that I have a margin account, so don't do this. But meaning, I can do 15 stocks. I can borrow 50% sometimes, depending on your margin allowances on your firm. So the point is, so let's say you are more conservative with regards to how you want to diversify your swing trades. Now, when I say diversify, keep in mind, I have my investments, which are holds that I don't really care about the technicals. I just believe based on other things that it's a good hold for 10 years. And that's a whole different strategy. And it's actually doesn't bode very well, truth be told. I have my swing trades, which is what we're talking about tonight, not doing too poorly, right? I showed you that. And then I have my day trades, which maybe we do a course on that someday because it's literally just a shortened version of what we're doing here. But instead of daily candles, we talk about 1-minute candles. So you have to master swing trading before being able to think on a minute-to-minute basis, but it's no different. And actually, I'm more profitable on that. My goal is 5% a day on my day trades, and that compounds nicely, but it's stressful. And we have, and everyone has jobs, but yeah, to answer your question then on the job piece, how often do I check this? So you can download a myriad of free apps, right? Hey, if you have an iPhone, guess what? You already have a stock app on there, right? But all you really need to do is, let's say you have 10 stocks or 20 stocks or 100 stocks. Please don't have 100 stocks. It's impossible to manage that. The goal here is to make money, not to own the S&P 500, right?
Right.
So, find the stocks you would like, and we'll talk about that as well. And then put them on your watch list. And most apps on a phone, you can add a moving average, add the 200-day moving average, and maybe look at it every night. I'll tell you this, this is my thing. I look at my stocks every day, but I never trade my swing trades intraday. That's not, no, you don't do that. You may trade them at the end of the day. And you know what? If it closed below the 200-day moving average and the market is closed, guess what? You sell it the next day. Because why? You've probably been in that trade for 6 months, a year, maybe longer in some cases when we look
Right.
at these. Coca-Cola, not the case. But yeah, so in some of these trades, you're in them for so long that if you miss it by a day, sure, it wasn't optimal, but you're still in profit. So that's okay. Also, as an example, on this chart, if you're far away from the 200-day moving average, for the most part, other than COVID, for the most part, unless there's something in the news that would alert you to, hey, I better look at my investments, you're not worried about the very next day dropping through the 200-day moving average. So where you start checking your phone is if you get a dramatic drop and a dramatic drop, and all of a sudden you're like, oh my gosh, I'm getting near the 200-day
Yeah, we're
moving
there.
average. Check it, once a day, 30 seconds, that's worth it, right? In what other career can you spend 30 seconds a day and make 300% of your money in, a few years? That's,
Right.
it's not a bad deal.
You got to watch if Ronaldo decides to drink water instead of Coke.
Yes.
All right. So
That's what dropped it.
who owns Coca-Cola here? What are we doing? What are we going for here?
I own some Coca-Cola.
Okay.
Ryan does. He's the one that asked.
Okay. Well, good question here on this one. So it's something I mentioned before, and if you are writing things down, please do. If not, if we do another seminar on this, you'll hear me say this over and over. Every stock has a personality, but there's very few personalities. I'd say there's 4 or 5 types of personalities. So don't think there's 1,000 you have to learn. One of the ones is, for me, if I'm going to truly swing trade a stock, right? Like, let's just say for some reason Pablo came to me, it's like, man, no, Coca-Cola, I'm killing it. And I'd be like, all right, cool. I like it. I know Coca-Cola. It seems like a good company. Maybe it's a good swing trade. I would look at this chart and go, wow. So it's above the 200 here at 40. It comes up. I would have been out and in back at 40. I would have been, oh, wow, profitable, but then out and in back at 43. And honestly, all you do to identify a personality, measured against your strategy. So the strategy we're talking about is the 200-day. Now, don't get me wrong. This stock loves the 200-day, but in no consistent manner. So for me, I'd say, no way is this going to be a swing trade for me. I may day trade this because this has some wild swings to it. And then, of course, that's just a shortened time version. So we'll get into this in a minute. But instead of using the 200-day, what would I do? I shorten it to the 20-day moving average, and I trade the 20-day moving average. Now, don't get me wrong. This will take a lot more eyes on. You'll get chopped in. Coca-Cola is terrible for this, actually, too. So to me, personally, I would not own Coca-Cola. Why? It doesn't fit my strategies. Does it fit some long-term investment strategy that I just believe in the company because it's been there forever and it pays a nice dividend? Sure, maybe, great. Put it in that basket. But it doesn't, based on what I'm talking about now, the 20-day moving average, I would be chopped in and out of this thing almost on a weekly basis. Don't like that.
Yeah.
So you know what I do? I disqualify it. And I will also tell you, that's rare. So, okay, so I appreciate you bringing up Coca-Cola. It doesn't fit this strategy. It doesn't mean it's not a good investment. All right? It doesn't. It can be a wonderful investment. But let's just take a look at something really quickly. So this fell from $60. Okay, that's not bad, actually. $60 to $36. That's in line with the rest of the mainstream stocks during COVID. So for me, yeah, I mean, you could, don't get me wrong, you could trade this up and over on the 200-day strategy, but you wouldn't make much, right? The goal of this strategy literally is, let's find the personalities of stocks that bode the most for us. If you want to get into it from a gaming perspective, and you like the idea of chasing the stocks and that cool thing, that can get you into trouble. How about we find the easy winners first? Let's find those first, and then let's have some fun after that.
We have a couple questions.
Yeah, go ahead.
Okay, so if we're starting to invest, do you recommend investing in large companies to start versus smaller ones?
Okay, good question. I love these questions. Yes, I would. Now, I will tell you, smaller companies tend to derive more profit. But if you're doing smaller companies, yes, you can make literally. Yesterday, a small company that was up 200% in one day, right? I mean, you don't get the whole thing by the time you figure it out. But the point of it is small companies can move quickly, but they can also move down extremely quickly. So what I would submit is, learn to crawl before you walk. Learn to drive a car before a truck, or a motorcycle, right? The point of swing trading is this. If you master swing trading, and I know guys and gals who have mastered this less than a year, it took me forever. I'm a slow learner, I guess. If you master this, then you can take it to a shorter time frame. So instead of using the 200-day moving average, start using the 50-day moving average. If you master that, use the 20-day. If you master that, use the 9-day. If you master that, then you go to day trading, which is exciting. I mean, I'm literally in and out of trades in 5 minutes, and
Wow.
you made your daily profit, right? Or loss, for that matter. But here, and here's another example here, right? I think tonight, if you wanted to, at the end, why don't we even make a watch list? Like maybe 10 stocks that have a personality that we could all trade together. Here's one. I'm not even necessarily a fan of it, but Boeing, right? Now, why do I like this? It's a large cap company. Yes, there are years of chop, right? But the chop is over the course of months. And when I say chop, it means crisscross, you'd be in and out. But it's like, all right, you're in, you're out the next month, maybe small losses, maybe small wins, not a big deal. But what I like about the personality is when you look backwards on the stock, when it does break above, does for the most part, it hang above and stay in a pattern. Yes, because these are cruise ships. They don't turn on a dime. So as an example, back in, you go back far, this is 2012, you would have been at 76. You could have just bought this in 2012 and ridden it for 2 years, from 71 to 121. And we're not talking about comparing to a Tesla. We're not comparing to whatever. We're talking about putting your money to work safely, growing better than a bank account. Let's look at this. So there's years of chop in 2014. You would have been chopped in and out twice, actually. Not bad. Out, you never cross back over. In, out, in. So a couple times. Then in, and then half a year later, half a year, out. So anyway, so you see the chop. I don't need to explain each one. But we'd already know the personality. And if you go far enough back, you see the personality. And then you're back in here in 2016 at 130. And voila. I mean, come on. If you were being a purist and never took profit along the way, you rode it from 130 to $350, right? Now look at Boeing. Boeing crashed because of COVID. It crossed the 50. If you got in, because I'm a big fan of industries like, Northrop, Lockheed, yada, yada. They're huge companies. Got back in at 182. Yeah, it's a lot of chop, right? A lot of chop. And right there, I got out and in, but that was at 221. I mean, come on, that's gimme money, right? It's a binary process. And Pablo, I'm surprised you haven't written a script for a computer to do this.
He's working on it.
On the list.
All right, and you know what? This is the cool thing. We're not even incorporating candlesticks or MACD or RSI. That's going to come later. So I want to make sure I want to close the chapter on this piece. But I kind of felt I almost didn't present this because it's almost like, really, is it that easy? And in one sense of the word, it is. If you don't mind missing the highest high and not getting in at the lowest low, remember what this strategy focuses on is gaining the meat of the move and protecting against the meat of the move on the downside. Because look at this: you got chopped around in here. You would have been out in, out in. Basically at the same level, so it'd almost be a nothing burger, but it went back up. Could you take profit? Sure, but if you really rode this back down, you're back out for a little bit of profit, chopped around for a bit. But the point of it is that chop is the work you must put in over the course of months to protect against when you're underneath. Okay, finally you're out. You just think this thing's going to chop around forever. You got out at 358 and it drops to $90.
Yeah, wow.
It dropped 60% and it saved you, where everyone else who has a portfolio with Boeing in it wrote it 60% down and is still to this date underwater. Whereas you would have got out here at 360, and you would have got back in at 180. Pretty cool, huh? I mean, I think it is. So And you know what's sad? That probably took me a decade to figure out. So that's so
Yeah.
sad.
Pablo asked for Bitcoin.
Oh, Bitcoin. All right. Now, okay, I'll be the first one to say Bitcoin's tough. All right. Any crypto, anything that trades 24 hours a day. Come on, y'all. That's tough. What are you going to do? Stay up all night? But let's do that.
Yes.
I had it at the ready because I figured someone was going to ask. So, all right. So, yeah, here's the 200-day moving average. And you literally could have done the same thing. This is the 200-day moving average in yellow or orange or whatever that is.
Yep.
So,
It
gosh.
stays above it quite a bit.
Well, that's the point. I mean, look, at the end of the day, maybe I'm trying to make this fancier than it is. It's not fancy. You would have got into the April of 2020 at $8,000. That's the only entry point, and the only other exit point is $40,000, a 500% increase. Okay. You know, if you knew nothing about cryptocurrencies and you knew this strategy, it's that boring. But you know what actually happens in between? You were up here at almost $70,000. You drop down here to 40. You see your net worth go, ah! And we all do this. I've been doing this for almost 2 decades, and we all do this. Oh man, I just just lost, like whatever, 30%. No, you didn't. You just gained 400% from your entry. But we all do it. We all measure from the high water mark. So come on, we do that. Now I don't trade Bitcoin off the 200. I actually traded off the 20, as many of you, or as at least 2 of you know. But let's just say, look, let's say you didn't want to get into the weeds of any more technicals and it confused you or whatever. It doesn't get any easier than this. The 200-day moving average on most. And how do you test this? If you're looking at stocks, look at its personality, look at its chart, look at its history on how it has reacted around the 200. If it's constantly, just constantly whipping around the 200 like Coca-Cola, it doesn't bode well for this strategy. But you're going to find overarchingly the majority of stocks do fall well within this strategy. And it's not your goal to own 500 stocks. Your goal is to grow your money. And so what you would do, and how part of the strategy behind the scenes is, you need to be investing the same amount into each stock within your strategy. Because let's say you invest $100 in one stock and it goes up 50%. Great, you made $50. So you're like, great, I'm going to invest 1,000 in the next one. Well, then that goes down 10%. Well, you made $50 on the first trade, and it was an incredibly profitable trade from a percentage. But you only lost 10% on the next, but you lost more money because you invested more money. So using equal amounts for whatever your strategy, this strategy, have 10 stocks for this strategy, or 20, it doesn't matter. Have 10 stocks at a minimum though. Have 10 stocks at a minimum, and you don't have to have them all at once. Start with one. Have 10 stocks though. And so whatever your account size is, let's say you're going to start with $1,000, $10,000, $100,000, whatever it is, doesn't matter. Take 10% of it when you find a stock and invest it in that stock, knowing that it may not be a winner the first time. That's okay, because this strategy overarchingly works. Okay.
Dan had a question.
Yeah.
He said, I've seen that people use longer average for 50, 100, 200 for longer term trading, and shorter averages for shorter term trading, 10, 20. But what actually dictates that number choice?
Yeah, good question. Okay, very good question. I tried to allude this earlier, and I might have minced my words, is the longer term your view on your strategy, the longer the longer moving average you want. Meaning, think about it for a minute. The 200-day moving average is going to be very slow moving, because every day when you tick forward one day, it's still averaging out the last 200 days. That's a lot of data points. So even if the stock goes up like 100% that day, that moving average will make a small blip because it's averaging out 99 days of almost non-movement. So it's going to be a very slow moving average. So if you're looking to be a faster trader, maybe try to secure more profit. And what I mean by that is let's use an example. Here's Boeing. Here's the 200-day moving average. Let's say that I am more interested in grabbing the high highs and getting in at the low lows. Now, if you use a faster moving average, let's say the 50-day moving average, well, compared to the 200-day moving average, which has 200 data points averaged together, so it's slow moving, the 50-day is only looking at the last 50 days. So that's going to jerk around a lot faster. So let's add that. Oh, I got there. All right. So I've added my 50-day moving average. If you can see it, it's in blue. Now, you'll notice it moves a lot faster. When the market drops, it drops faster. Why? Because it's only looking at the last 50 days. So it's going to adjust much quicker than looking at the last 200 days. So I will tell you what I do on stocks to judge the personality. Many times I'll use the 200-day, the 50-day, even the 20-day. If I'm, if you have time to sit in front of your computer every day, use the 20-day. If you have time to sit in front of your computer every week, use the 50. But if you're looking for solid investing, use the 200. They'll be easier and you won't have to worry too much. But as an example, let's look at the 50. Same idea. 50-day moving average, you would have been out, you would have been in. You would have been out, you would have been in. So again, since it's a fast moving average, you're going to get chopped out a lot faster. But you can also secure more profit too. And what I mean by that is you're back in actually relatively the same place as the 200, but you're going up, you're 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 up. You sold there, you made some nice profit, you're back in, you're out again, you're getting chopped around, getting chop, 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 chop. But you're back in here and you have this takeoff and you're selling here. Probably not the greatest example, but here's a great example. When the market tanks, where would you get back in? Instead of getting in over here at 180, you would have been in here at 136, but you get chopped out here at 170s. You're still making profit. But the point of using a faster moving average, the result rather of using a faster moving average, you are going to be in and out more often, but you can tend to make more profit. Yep. You just have to choose your, what you prefer to use. Does that make sense?
He said, got it. Thank you.
Okay. Well, I'll show and I'll take it to one level more if you're interested here. I'll bring back to Tesla because that's one of my favorites. All right, so let's just bring a few things on your watch list. Let's just start building our watch list for the night. Great. Boeing, I mean, come on. We just looked at it. Why not? I mean, it loves that 200-day. And again, always have 3 baskets of investments. Have your long-term for whatever you already have. And if you believe in it, good. I won't address that. Your swing trades is what we're talking about tonight. Have that basket, have this strategy. You need, I have 3 sources of income, right? Swing trading, day trading, investing. Yes, it all comes from the same spot, but for very different reasons. But then if you're interested, get into day trading. Again, these are all different sources of income. So here is not Tesla. Hang on a second. All right, let's bring up Tesla. Put Tesla on your watch list for sure. It trades like a penny stock. Someone asked earlier, what's better, large cap or small caps? Tesla's the best of both worlds. It's a large cap company that trades like a small cap company, meaning wild swings. It's awesome. So you can definitely use the 200-day. Hey, look, if you don't have time for this, use the 200-day. You will bode very well. If you've got some time, use the 50-day. You'll have times of being chopped out. But look, I mean, for something like Tesla that has wild but awesome swings. So let's analyze the personality together of Tesla versus Boeing. We saw Boeing's personality. Pretty boring. Kind of like what you want, right? But Tesla's exciting. You're in. Man, you're in from 50. You're up at 200. You could take some profit if you want, but instead of waiting for it to break back below the 200 for maybe even break even after making that much profit, if you're using the 50, at least you went up from $50 and you would have got out at 127, right? Not bad. Where would you have been back in on the 50? If you're just using the 50, and again, you can always use hybrid, you would have been back in basically the same spot, 140. Yeah. Where would you have gotten out? This was a dip below. It didn't close below. You would have closed right here at 420.
Yikes.
So again, so other than the 200, you would have still been in, right? But you're all with this, you're chopped around, but you're actually back in right where you got out. So other than taxable consequences, you're good to go. You ride this back up, and where would you have gotten out? You would have gotten out here at 760, not at 580. So again, I'll reiterate the point. If you don't mind getting chopped around in taxable consequences, meaning what if you're doing this in your IRA or a Roth account? No taxable consequences, no big deal. If you have the time, you can do this and you can actually make more profit doing it this way. But rest assured, if you use the 200, yes, you'll never get the highest high and you'll never get the lowest low, but you will protect your profits. Now, when I was talking also about when I showed my stats earlier and it showed that I was 54% profitable, right? 54%. And yet I've had a profit curve, you know, over the last, what, from 2018 to now on this type of trading of 1.3, not bad. And the reason why, though, it looks so terrible is, let's say you get in right when you cross the 200, because that's the marker. Well, many times the stock fails within the next day or two and comes right back under the 200. Cut your number one rule. And I have this in my PowerPoint, and we don't need to go back to it. Number one rule of any trading, swing trading, day trading, or investing, number one rule: cut your losses early. First of all, you never get into an investment. You never get into a trade. Never, never, never get into a trade until you have a thesis. Your thesis tells you why you're getting in and when you are getting out. This one's a pretty simple thesis. You're getting in because it's above the 200. You're getting out because it's below the 200. Pretty simple thesis. When you break that rule, you will lose money. Oh, it's below the 200, but I think it's going to bounce back. Trust me. They don't.
Yeah.
We call it market tuition. I've paid a lot of market tuition. So, all right. So I think I've beaten this horse to death. What do you think? Any questions before we go on to maybe something a little bit more exciting?
We had sorry, there's one question I want to go back to.
And also let me ask you this too, and please answer it, everybody, is you know, and be honest, it's fine. Is this helpful? I mean, truly. If it's not, maybe it's too basic for some folks too.
Yeah, no, John,
Absolutely.
I'll just say, I think it's super helpful. I think that I do want to make sure that we're not skipping over some very, and we may think of it as very basic, but for example, even how to create the watch list, for example, in TradingView is just that plus in the top right, you name it. And then any stock that you're looking at, you can just you know, type it in the top left, and then you can add it to that watch list that you created. So you can test it out and delete a watch list so you don't break anything. I would recommend doing that now if you're playing around with it. And then the other thing is, with how do you use TradingView with your account, is you can view the stock on something like TradingView, and you don't necessarily have to buy and trade here, right? You don't have to connect anything to this. You're just viewing it as a reader, so to say. And then you're seeing, oh, hey, I'm about to break up on or I closed above the 200 day, right? And then you would go to your brokerage account, like your other account, and then you would execute the you know, the buy. So I just want to make sure that that's clear as well, that, you know, we're using this more like a reader, like a dashboard, so to say.
Yeah. And Pablo, thank you for that. And actually, that's what I struggled about today. I have all my notes in front of me, and the funny thing is, it goes off in a million different directions. And you know, if you all are interested, I'd be happy to do this, you know, every night of every week. No, but seriously, I would, is because this, unfortunately, you know, we're trying to compact so much information into a single piece, and there's a lot of things. Pablo, thank you for that. That exactly right. You know, I'm skipping some maybe even basic things, and I remember that too when I was learning. Is I'm like, great, I understand your concept, but how do I even get there? Like, what, you know, how do I know what to even look for? So you're absolutely right. Is, you know, if you're using something like TraderView, I mean, I mean, honestly, if you use an iPhone, I'll tell you exactly what I use. It's a free app too, which is, you just got to deal with the ads. I think it's just called Stocks, which is sad, but I think it's called Stockmaster or Stocks thing. I was like, I'm gonna just take a look, make sure I know what the name is. and it is one that I mean, literally, I use it. It's what I use all the time. But it's a green. The icon. Let me type it in. If you type in stock in the app store, stock master. Yeah. All right. If you type in stock master, it's a green. It's like it's the first or second one to pop up. It's a green little icon. I'm not sure if you can see this. Nope. It will. But anyway, it's free and you can create watch lists. But almost any program you have to kind of learn by yourself. It's okay. There's always watch lists on every program. On stock view, it's really easy. On the right hand side, watch list. There's a little plus sign like every program out there. You hit plus and you type in the symbol. If you don't know the symbol, Google it. Like what is Tesla's? They're called tickers, by the way. If you don't know that, ticker symbols, but just ticker. So you can type into Google what is, whatever, so-and-so's ticker. It'll give it to you. It'll be the first thing that pops up on Google. So, you can type in TSLA and there's Tesla. You click on it. You can look up more, but if you don't, just hit close. And if it should be in my watch list here somewhere. I did add it, didn't I? Let me try one more time. Oh, there it is. Yeah. Okay. I obviously didn't click it well enough. There it is down here, Tesla. So, you can delete and add and delete anything in here, but you can create your watch list. But how do you create a watch list? How do you know even where to start? Should we address that now?
Sure.
Okay.
Yeah.
Yeah, I think so.
Yes, I like that because I think at the end of the day, it's like, great, maybe we know how to trade, but what do we trade, right? Like at the end of the day. All right. Also, the cool thing is, and I know there's this debatable and I break it all the time, but when we get into other strategies, whether it's tonight or not, maybe more interesting ones, one of the rules that I do keep in mind, I break all the time, but at least I keep it in mind is if it's below the 200-day moving average, just know the probability of failure is much higher. So if you're even trading a stock, a good note to write down is it above the 200? Because institutions who trade stocks, and I'm part of that, so I know what, trust me. We look at the 200-day and yeah, we'll bottom feed. If something sells off, we'll buy it. But when it gets close to the 200 from underneath, we sell it, which pushes the stock back down. So it's just a self-fulfilling prophecy at the end of the day. But eventually it'll work its way back up. But again, if you want to increase your odds, trade, and this is only a beginner note. If you want to increase your odds, trade stocks that are above the 200-day moving average. Oh, yeah, I don't even know if I addressed Bitcoin, but real quickly, before we get into the watch list, here's Bitcoin. Here's, if we were to look at it, well, look, it finally broke through the 200-day and wow, it almost made it back. Nope, rejected. Oh, it got back, rejected. Now, it doesn't mean that it won't break back above. And it doesn't mean that I'm not in it because I trade the 20-day moving average on this one, which we happen to be above right now. But that being said, is I'm very well aware in my trading style because I'm Bitcoin and those types of things. I get chopped out a lot, as you can probably tell from this chart. But that's what I do. But I'm very well aware that I have a high sensitivity to that 200-day moving average. There's a heavier resistance on the longer the average, meaning the 200-day moving average means much more than the 50-day moving average and much more than the 20-day moving average. So from a hierarchy point of view, understand that. Let's go to how do we find stocks?
I had a quick question, John,
Yeah,
as we're going. I feel I would just love to hear you speak about in your experience. Probably one of the things I hear the most when it comes to early traders or just trading in general is like the idea of the gut feeling and like how have you navigated that? What's your experience of like you have this gut feeling that it's just gonna do something, or is that just so beyond something you feel anymore?
You know what? The gut feeling is the worst thing to be rewarded for. When you have a gut feeling and it works out, that's the worst thing that could ever happen to you. because you'll use that gut feeling again. And these are simple stats that I would refer back to the gut feeling. And I've been there. I've used gut feelings even in my day trading. I win. I'm like, yeah, obviously. I do that again and I lose twice as much. But the point of this is these are the data points of people who use gut feelings, right? According to eToro, who they track all stats, they found that a whopping 80, well, we talked about this. Well, here's the profit margin here. Trader survival rate, right? 1% is profitable, 7% remain after 5 years, meaning individuals who trade their own accounts. 80% quit after 2 years, etc. But the point of it is this: I can't tell you the amount of people who tell me about that 1 or 2 awesome winner. And you know what? Even today, I was talking to a buddy who was talking to his buddy who, invested in Apple $1 million back in the day, when he made money doing something else. And of course, now is reaping the rewards. So we all hear those stories, but for every one of those stories, there's 10,000 people who did that on a MCI. And if you're not familiar with what happened to that company, it went to nada, right?
Yeah.
So the Enron, right? A company that could not fail, gone. So don't ever trust me. I get this all the time. Don't ever listen to people who tell you how great they are, including me, right? I hope I'm not saying this. For everyone who tells you about their great trade, they have 10 bad trades. And don't get me wrong, if you have a gut feeling, maybe that gut feeling is actually not a feeling. Maybe it's actually based on something you read or data that you brought in. So you have to discern yourself. Is it really a feeling, or is it really based on data that you've been absorbing? And you're like, well, I've read enough data that I feel this way. But don't go off a feeling, go off data. If you have a feeling, go find the data to back it up. I'm just telling you this. Look, you may get a home run here and there, and those feel great. But if you're going to make this a business, maybe not a business as in the proverbial sense, but if you're going to last and make your portfolio last and make your portfolio grow, you need to have consistency. And it's not getting home run after home run. It's getting the singles and doubles over and over, day after day, week after week, month after month. And it's boring. It's boring. It is. But you know what? What becomes boring to you, other people would wish for. I'll show you my own account. I'll open it up. Getting a 20, 30, 40% trade over the course of months. Most people would love to have that in a year, but that actually becomes very run rate boring because you want more. You always want more. Don't listen. I always like to say, don't let the distractions distract you. Everyone's going to tell you about their good trades. No one's going to tell you about the bad ones. I'll tell you about the bad ones. So,
That's good, John.
Does that answer your question?
Yeah, that's great.
Okay. Watch list?
Yes.
All right. Let's do it. Make sure I don't. Okay. So, best website I ever learned from another guy many, many years ago. It's called FinViz. It's free. Can't get better than that. Stands for financial visualization. This is where you will always create watch lists, in my opinion. I will say I do pay for a paid subscription for my day trading, which is a scanner here. It's called Benzinga. If you're day trading, you would want something like this. It pops things up every second something's moving, but that's only if you live in front of your computer. So for those who don't do that, this is also what I use for my swing trades. If you don't pay for it, you have to deal with the constant ad pop-ups, but that's okay. So a couple things here, right? There's a couple ways to approach this, which are all easy. This website is, as you'll see, it gives you a little bit of everything. It even tells you things that are, top gainers, overbought, unusual volume. And when you get to that, level, those are going to be important. But in the meantime, you're going to go to finviz.com, stands for financial visualization. Very easy. You're going to click on screener. That will then bring up 412 pages of stocks. So about 10,000 stocks. So we got to whittle that down a little bit. So who's going to be the first to answer? What's the number one thing we're looking for? What kind of, what moving average do we want to ideally?
For retirement seems very complex.
Oh, see?
Steven,
even playing an ad for me right now.
So that's great because the green.
I don't even know where that ad is. There it is.
Sorry.
Okay. All right. So so if we're going to screen for something, because we have all these different things that we can screen for, and don't get wrapped up in all these things. What's the number one thing we're just looking for? What do we want to trade above or below?
The 200-day.
200 moving average.
Uh-oh, did I lose you all? Miko?
Yep. Got you. Hear me?
Uh-oh. Can you hear me?
Hello. Hello. I got you. We hear you.
Somehow I lost you. Give me a second.
We got you. We got you. Hello.
It's these ads.
I did lose you. Hey, I'm going to be right back. I'm going to log out, log back in. I've just lost you guys. I'll be right back. If you
No
can hear
problem,
me,
man.
stand
Yeah,
by.
we hear you. Yep.
Hey, Nico.
Yeah. What's up, Pablo?
There's also a screener in TradingView.
Oh, okay.
I can show you guys after. I don't know. Let's see what John uses though. It may be easier or better,
Yeah.
but there's also one in TradingView. And for anyone that needs to drop off, you know, I know we're well over time. We'll take the notes and send you the information. It seems pretty straightforward though. Like if,
Yeah, it really
so,
does.
I guess you would want to find the stocks that are under the 200-day, that are fairly large cap, I would imagine, right? So maybe market cap with under the 200-day, and you keep that on the watch list, and then when it crosses over,
You get
All
in.
right.
you get in.
Can you guys hear me?
We got you, John.
Yep, we can hear you.
Okay. Well, I can't hear you all, but I can see mouths moving. That does not bode well. I
Dang.
don't know what happened. All right. Well, Miko, you're going to just have to text me. I don't know. Questions. I don't know how that goes. But here, unfortunately, we're just going to move on. And unfortunately, for some reason, I don't know why I can't hear you guys now. But okay, so this is what we're going to do. You go to finviz.com, and I know we're running long in the tooth on time as well. In essence, I'll answer my own question. So the first thing we're looking for when you're up here in the screeners, you can go descriptive if you know what you're looking for, but you're going to go to technicals.
Nico,
Okay.
can you have him share a screen
In
again?
here,
We can't see his screen.
you'll see something that says the 200 simple moving average, which is what we just spent a lot of time talking about. And ideally, we want to
I'm
be
texting him.
trading stocks that are what? Above. Oh, yeah, I can share my screen. Thank you. Sorry about this mishap. I don't know what happened there with the audio. Okay. So yeah, so if you can see my screen, Miko, just keep texting me on these things. So what we're looking at FinViz, and then what you're looking at up here, you have the different tabs. So this is, quite easy. Descriptive, fundamental, and technical. What you're looking for is the technical piece. And then under there, you'll see the 200 simple day moving average, everything we just talked about, right? So what you're going to do then is there's a couple things you could do, right? But we could screen this just to sort this down. We could say, well, let's say, first we could say the price just crossed above the 200-day, which I think we're going to look at here in a minute. But more to the point, the simple moving average 200-day is above. Oh wait, as above. Let's see here. Let me just find it here. Give me a second. Here it is. Price above SMA 200. So let's go ahead and click that and filter it. That will bring us from 400 pages down to half those pages. So now we've already shortened down the world that we're looking for. So we can go from there, but what I mentioned is we want to be entering and or exiting around the 200. So if we're above the 200 on a stock, do we want to randomly enter it at that time? No. So let's go back to this here a moment, and let's click on price crossed above the 200-day. Because what that's going to do is it's going to filter down only to 16 pages, right? That's not a lot. It's going to filter down to 16 pages of stocks that have recently, and I mean very recently, crossed above the 200-day. I mean, come on, it doesn't make it much easier than that, right? So that's still a lot of stocks, 20 pages per stocks, 16 pages. So as we talked about here a moment ago, we want to focus for this strategy, at least, on the larger companies, which is what we call market cap. So what you can do in here is you click on market cap and it will start to filter by market cap. If you click it once, it's the smallest market cap, so we don't want that. Click it twice, you get the larger one.
Disney.
Okay. Now, what we're going to do, so the 2 steps, right? That's it. Now what we're going to do is right above this filter, above it, you'll see a tab that says charts. You're going to click on charts. And instead of just having a list of stocks, you now have the charts based and ranked on how we just filtered. So again, doesn't get much easier than that. So now this is where science meets art, but you all can do this, even if this is your first day even looking at something like this. And what I mean by that is simply this. Even though these are itty bitty charts and you can click on each one if you really wanted to and it expands, a quick way of just running through these. And this literally will take you 5 minutes. And when you, oh, Miko, are you shaking your head? Can you hear me?
Oh,
Well, I can't hear you, so this, I don't know why I'm asking. Gosh, I don't know. Oh, I think I know what happened. Give me a second. Oh, give me a second. I think I know what happened. All right. Say something now, Miko.
hello, hello.
There, I got you. All right.
Yeah, no, we were just like, man, this is so good.
All right.
I was
shaking
shaking
your
my
head.
head.
You're like, I can't believe he's showing us this.
Yeah,
stuff.
this is so
terrible.
good, yeah.
So, yeah, like, all right, fine. We'll do something else. All right. So, okay. All right. This is where it gets fun. All right. Yeah. This off is probably pretty boring so far, but this is where it gets fun, right? The trading the 200-day moving average, super boring, but hey, it makes money. All right. At the end of the day. And really what I wanted to talk about tonight was actually something different. And if we have time, we will do it. Else we'll do a follow-up, which is actually more exciting and actually more profitable, but not as easy, maybe. But again, let's just finish this thought, because if you can conquer just this one strategy, literally, this will put you in the top 10 percentile of just investors alone. I mean, it's that easy, right? Give or take, and then you'll learn to overlay things. So what we do is, ideally, right? What are we truly, think of it just from a psychological point of view. What kind of stock do we really want to buy? Yes, ideally, as we just looked at, something that pays attention to the 200-day. So if we were to look, here's DIS. If you know what that is, that's Disney. So what's on here, and you can see this little light green is the 200-day. So let's just take a look at this for a moment and just use your logic now. This is where the art comes in, but it's still using logic. So let's look at this. Disney back in November broke above the 200-day. It went crazy. It went from 110 to 100% increase, and now it's slowly coming down, and it broke below the 200, but it's back up. Now, why did this meet our criteria? Because literally today it broke above the 200. But do I really want to buy this? No, I don't. Why? Well, it doesn't mean that it doesn't bounce off the 200 and continue up. Could it? Sure. But I'm not looking for a possibility. I'm looking to put the odds in my favor in a massive way. That's all investing is. Finding how to put the odds in your favor so you win the vast majority of the time. And simply by coming down and bouncing off the 200-day or in and around that, that's not good to me. Ideally, what I would want to see is a stock that's been beaten up pretty good and then gets above the 200-day.
Primed.
From groupthink, and remember, who are you trading with? 80% of traders, 8 out of 10, actually a little bit more, are institutions who go, man, this thing's on sale. And it bounced above the 200-day. That's a buy signal. What makes stocks go up and down? Buyers and sellers. They don't have a mind of their own. If there are more buyers than sellers, that stock moves up. If there are more sellers than buyers, the stock moves down. When you get above the 200-day and it reaches our scanners as institutional investors, and it's a mainstream stock, we go, well, that's interesting. Looks like a buy. Let's buy. I mean, come on, group think. That's really, even day trading, it's group think. It's just very fast group think. So Disney, don't get me wrong, may be a great investment, but this is not a great swing trade. So let's identify something. Let's just keep going through this. Remember, I had sorted this by market cap. So Disney, based on the criteria we're looking for, is the largest company. Remember, what's the criteria? Something that just crossed above the 200. So how often would I run this scan? You could run it every day, but truly, if this was not like a full-time thing for you, you could run it every week. You could run it every couple weeks. You could run it every month, right? If you already have 10 stocks, so as you're building your portfolio, if you don't already have one, you may only find one stock every few weeks, right? So it may take you a long time to get to 10 stocks. It may take you weeks or months to find it, depending on the market. Meaning when COVID happened and the market dropped 40% in 3 weeks, a couple of weeks after that, almost everything was registering on your scanner. And that makes it actually difficult in a weird way. But the point of that is you will eventually get your 10 stocks. And once you do that, yes, there'll be opportunities. But that kind of actually makes you eager to sell one of yours. You in a weird way, when you're up like 20, 30, 40% on a stock, you kind of want it to drop below the 200 because you start identifying other opportunities. You're like, but I already have a full portfolio. And yes, even though your portfolio is making money, you're like, but I want this one. So that's where it gets kind of funny.
Right.
All right.
Coinbase looks interesting.
Oh, yes, it does. Actually, is that on here?
Coin,
Oh,
I think.
yeah, there it is. That's funny you say that. I like it. A little bit more speculative. You know what? Let's go to the big screen for this one. So what do we have so far for a potential watch list? Boeing, Tesla. Now those, as we know, they're not just crossing, but let's see. I don't have my 200-day on here. I don't think. Let me see, zoom out really far. Nope. Oh, that's because we don't have 200 days worth of data on here.
Right. So does that cancel it?
Well, okay, but I would submit, let's put Coinbase on here. So what I love about this is, okay, you guys all and gals, I don't want to exclude anybody. You probably noticed this. Whenever an IPO comes out, I don't care if it's Facebook, Coinbase, whatever. Robinhood's come an exception to the rule. They typically drop for weeks out of the gate. So, be careful on that. So when you have an IPO, you literally have to have 200 days of trading, 3/4 of a year before the 200-day even pops up. So what I like to use is the 20-day moving average. And this is how I use the 20-day moving average. Write this down, even though this is maybe later tonight or even another course, is how I use the 20-day moving average. I do not buy the day that it closes above, nor the sell on the day it closes below. I use 2 consecutive days above, consecutive, back to back. So as an example, Coinbase opened up here, was in the 400s, and it just got creamed, right? Came down to 200s, 50%. Came back up here above the 20-day moving average. Here, closed right on it. That's a judgment call. When it does that for me, I don't buy. But I'm looking for 2 consecutive days, and consequently, it fell back under. So that's a no buy. Over here, jumped up, jumped in. That was a buy. It doesn't mean it's going to work out, but that was a buy. I held, loss. See, doesn't mean it's going to work out for you. But why do I like it? It sold off 50%, folks. It's on sale. Doesn't mean the first stab, second stab, or even third stab is going to work. But it means that when it does work, you're gonna make up for the little bitty losses you have along the way. So you hold, you wait. 1 day above, 1 day below, no buy. 1 day above, 1 day below, no buy. Same. So today would actually be a buy, and I didn't even notice that. And I really like it because whenever you cross a previous high, we're not quite there yet. It's testing it. But if you break above that tomorrow, the next target is $300, and we're at $255. Highly recommend looking at that tomorrow, by the way. Highly recommend it. Today was the buy signal if you're looking for that shorter term trade. Keep in mind, though, understand your risk tolerance. The 20-day moving average is back here at 235. You're risking at least 10%. So keep that in perspective, right? But it's all about risk reward at the end of the day. Is understand the amount of money you're willing to lose on a single trade, because it's not about the percentage, meaning, okay, I lose 10%, but 10% of a dollar, not a bad deal. 10% of 100,000, kind of a big deal. But understand that there's not a lot of resistance. Actually, there's no resistance really until the $300 range. So there's a lot of profit to be made there. A lot of profit to be made. There's no golden egg. There's none of that. Just keep Coinbase. Feel free to dip your toe in. Maybe buy one share tomorrow just to have fun with it. If I'm having fun with a stock, I typically buy 4 shares just for fun. Why? I like to sell in quarters. So in order to do that, you need at least 4 shares. So, but yeah, good call. I like the Coinbase.
And why? So can you explain why is it like a potential 10% loss just with the 20-day?
Good question. Yeah. So the 20-day, and it could be more, right? So the idea is what you're risking. And I will say, the things that we're covering tonight are very important. We're going to probably have to have a part 2 and part 3 because that gets into questions you're talking about. All right, Micah, I saw that. And the reason for that is what we're talking about tonight is structure of the trade, but that we need structure of the trading system itself. So what I would do, I'll walk you through my methodology, and if it doesn't make sense, let's stay on it till it does. So what you'll notice is some very simple things. Actually, is what you want to look for on the downside, and I'm trying to find some examples on this chart. IPOs are a little bit difficult because it's kind of just sporadic. But anyway, so the idea is this: is if I were to get in on this, I risk 2 areas, and this is how I do the 20-day moving average. Is first of all, 2 days below the 20, I'm definitely out, no question about it. But if I have a high conviction on the trade, like a super high conviction, which is rare, but this one would actually be one of those, oddly enough, is what I would say is either 2 days below the 20 or the break of the last low. And what I mean by that is, so here's a low, we pump up, we drop, but it's a higher low, and then it recoups. So from a psychological point of view, think about, it's not about the chart. You have to understand that the chart is the fuel gauge in your car, the speedometer in your car. So remember that. What is the chart telling you about the temperature of the market? So let's walk through this. Someone's buying, it's making it go up. Okay, we have some profit takers because it hit to the penny, the 20-day moving average and the 9. These moving averages are used. There's nothing by accident in the market. I mean, watch this. Comes down, touches the 20, bounces off. Breaks the 20, comes back up and tests it and fail. Opens the next day, tests the 20, holds. I mean, these moving averages are not by accident. It doesn't mean that you know exactly what's going to happen, but when you're around moving averages, you keep your ears and eyes wide open because that is where all the activity occurs. So anyway, long story short is this. There's a lot going on here. Not all this is going to make sense to you. I'm just going to speak how I would trade this. I go, okay, I like Coinbase from the very get-go, just from the theology of it, if you will. But I'm waiting for my buy signal. Yes, I had a small loss here, but I still like it. So what I'm looking for is above the 20. And what I'm looking for here is, okay, we made a low, but this low in comparative to the chart, if we go backwards, look at this. This is interesting. Let me just bring in again, this is what technical analysis is about. Technical analysis is not a crystal ball. Technical analysis is about measuring group think. And if you can ride the coattails of group think, you're going to do quite well. So let's look at where let's look at this bottom over here. When a chart makes a low, I make a line and I go, okay, that line's important. For whatever reason, maybe I know, maybe I don't, it bounced there. That's important. Well, the next time it comes down and then takes off, I go, well, that's interesting. It didn't even go as low as the last time. So what that tells me is buyers came in before it even got to its lowest low. That tells me it has a bit of a bullish attitude towards it. Because if people were really bearish, they'd be like, oh man, it's near its lows. I'm out. I'm selling. And what does selling do? It tanks the stock way past the next low. And that's what you call lower lows. But this is a higher low. Okay.
I don't know why.
So then it takes off again, and that's interesting. But then it comes down and makes another low. And yes, I took a loss, but wait a minute. Now you don't know it in the real time, but once it takes off again, because hey, I'm not even in the trade yet because it's going back to the 20. But as it's going back to the 20, I go, well, wait a minute. it just made a higher low. So buyers came in before it even reached the previous low. So what is this doing? These are the pieces to be aware of. That's what technical analysis is. And the more you learn about technical analysis, the more you start to put in your favor. So I don't care if you know just about the 200-day moving average, all of a sudden you put more in your court. But then you learn about the MACD. Now you put more in your court. Now you learn about higher lows. And really, I will tell you this, I've used a lot of technicals in my day, and I've boiled it down to basically the MACD, the RSI, and higher lows in the 200-day. But at the end of the day, that's really all you need to make a successful trader if you do this, if you spend enough time. So what am I looking at now is, okay, wow. Now it's played with the 20, it's playing, it's trying to make decision. Bulls and bears are rectifying their books. But look at this, volume has come in. These are beautiful candles. So to me, I say, okay, buyers came in, beautiful long candle, not unlike what we saw here. But what happened here? Well, wait a minute, what's this blue line? That's a moving average. That's a 50-day moving average. We must always be aware of the moving averages. So what really happened here is, even though I love my 20-day, it came up and it got rejected off that 50 like there's no tomorrow. And yes, it played around. IPOs are not pure. They have a lot of speculative traders in there, but you'll see at least they like to hover around these areas. The point of saying this is you're going to take a lot of small losses, maybe even small gains in doing IPOs and this type of trading on the 20-day. But I look at the MACD, it's crossing over the zero line. It's in the positive direction. In legacy trader, I used to use CCI, not important. But anyway, the point of this is we're back above the 20. MACD is looking good. Volume's coming back in. If I really were to zoom out, we're above the volume shelf, which means it has support. There's no resistance until this volume shelf. All that volume profile or volume shelf means is that's where the bulk of buyers bought. So this tells me that the bulk of buyers are both here and here. And so what happens from a psychological point of view, that's all this boils down to, is when you reach here, it's going to have trouble because all the buyers that are reflected here say, man, it's finally back. I'm not down 50%. This is great. I need to sell. I mean, come on, we all know this, right? How many times have we all had a position that's down 10, 20, 30, 50%? And that you shouldn't have, by the way. But anyway, if you do, because you didn't cut your losses, it finally gets back to break even. The last thing you're thinking is, where can this go from here? The first thing you're thinking is,
I'm saved.
Oh, I'm out. No. And then it takes off for another 100%. But that's the point here is when you see the volume profile, that's why, in my opinion, volume profile is important, but don't get hung up on that. You don't need it right now. That's a later thing. But my point is this, there's not a lot of there's no resistance in here. There's not a lot of buyers or sellers in here, as you can see. So you're not going to find a lot of resistance until basically this 300 to 310 area. Don't be greedy. You can also see that right here, right? Most of that volume came in that first 3 days. And what happened when you sank below that volume profile? It came back up and what? Bounced right off the floor of that volume profile like it was a ceiling above your head, because that's what it is. So wow. I would say, you know what? There's no crystal ball, but this has a very high probability given the MACD, beautiful crossing above from the negative levels, has momentum, has gas in the tank according to our gauges, has volume coming in. It's now sitting above the volume shelf once again. Doesn't mean it didn't fail before, so it can, but there's a high probability that this gets back to the 300 level. Where does it go from there? Well, you have to recalculate, but don't be greedy. We know there's resistance overhead. Take profit. If not 25%, 50%, or rather the other way around. If not 50%, 25%. Take profit off the table, because this can always change where it goes. So that I belabored the point on that one, but that's coin.
John, also the 50 that was resistance is now support.
Exactly. Yes. Thank you, Pablo. So trite sayings, guys, I know it feels like you're drinking from a fire hose, but trust me, it's not an infinite world. It's a very small world. And once you learn these things, you hear them over and over and over enough. You're like, nah, there's nothing really new to learn, really. But one of the trite sayings is support becomes resistance and resistance becomes support. Now, what does that mean? Well, simply put, I want to really find a better, let me find a better stock than this. Oh, I know. I'll show you a stock I traded the other day as a day trade, but you don't have to worry about I mean, you can view each candle at, even though they are a minute long candle that I'm about to show you, you could view it as if it were a day. They're literally traded no different. So let me find it. Give me a second.
Ryan asked really quick, when you say you like to sell in quarters, do you mean you sell one fourth of your holdings at different thresholds that you're looking out for?
Very good question. Yes. Now that's a Bocekism, meaning that's my last name is, there's reasons I sell, but as an example, as a purist, as I just showed you, is as a purist, you should really just be using technical indicators and the chart. You really should be. But I will also submit this. If you're up 40, 50% on a position, come on. I sell a quarter at the end of the day. And you know what? That's bitten me quite a bit. But it because it can, continues on. But that's why I hold on to more. And if you go up another, 10, 20%, sell another quarter. And then of course, if you cross down through your moving averages, sell the rest. But I do that just because I like taking profit. And I probably take profit way too early. But why it's okay to start taking profit at 20% ish, even at 10% in most cases, is because I know with the losses that I have, I cut them so quickly because I'm buying them right near the moving average that if it fails the moving average, it's typically only a few percentage points anyway, right? So those losses are so small that even if you are taking a little bit of gains early, even that first one quarter is a bigger gain than most of your losses are, right? So, if that answers your question so where do you actually take that quarter? Well, again, to be honest, as a purist, you should just be watching moving averages and charts at the end of the day. But I don't, I mean, I do for my final exit, don't get me wrong. But for taking profit, if I'm up 20, 30, 40%, I'm taking a quarter off. And that is more based on feeling. I like securing profit. My dad used to say this all the time. No one went broke taking profit. That's true, right? So,
Yep.
Oh, okay. Here, give me a second. I really think you guys will find this interesting. We're talking about, I think, I'm harping on the same things over and over because it is important. I mean, if you hear the same thing over and over and over, you eventually like, I get it. So, all right. Here's a great example of a stock, by the way. I traded this all day yesterday. It was great. BYSI. It went from $10 to $30 in a day. Not bad.
Wow.
Yeah, 300% in a day. But it's not like you get all of that move, right? Okay, so. Okay. So what Miko was just saying is, hey, look, or Pablo, you're saying it is, hey, look, a certain moving average or a certain level becomes when a resistance level is broken, meaning a resistance. Think of resistance as the ceiling above your head because that's resistance, right? You're trying to go higher, but there's a ceiling above your head. You can't break through it. And support is your floor, the floor you're standing on. It's great. So let me explain how it actually works because it's not just a simple little line in the sand. There's actually a reason why this occurs is when you break through, when you break through a certain level, meaning as an example, this looks like a little bitty move, but I'm going to show you percentage-wise it's huge. So this stock sold off. You could choose any time frame, but in essence, the stock sold off and it came up, bounced off some seemingly random level. But was it random? Let's take a look. I mean, you can continue to go back and 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 back. But what you'll notice back here, pre-market, all the way back here, there's some wicks. I won't go into explaining that. I don't use them in pre-market. But I'm drawing a line where it had trouble breaking pre-market. And then there's some other things. Again, you could choose. There's so many. There's a lot of time frames you can choose, but that's a whole nother seminar maybe. So I draw. I'm looking at this. And this is not drawn in real time per se, but what I'm looking for is when the market opens and it starts to react at certain levels. It came down and reacted at this level and bounced. So as soon as it did that, I go, well, why is this important? Why is this level important? And I look back and I'm like, oh, that's interesting. This was resistance. And so it got shut down. And now it becomes support. So what was resistance, once you're above it, becomes support. And there's so many ways to trade that. Meaning, if it comes down there, you could randomly buy it. Don't advise that, but you could. But the point of it is when stocks come down to previous resistance levels that it broke through, there's a high probability of a bounce. And this bounced there from $24 and in 2 minutes went to 27. That's not bad. What is that? 16% or something. But the point of that is, so then it comes back down and it breaks through that support. But what did it do? Came back up to the penny and tested. Why? Because support now became resistance. Well, look, without even moving the line, we break through it. Now resistance becomes support. And then support. And then you break through again and it becomes resistance. Literally, you can't make this stuff up, but that's how important it is. Now, why does that occur? Well, when you're trying to break through a previous area, everyone's aware of that from an investor point of view. So they get to that area and you start selling your position. Well, in order to sell your position, there must be a buyer. And so if buyers are buying at that area, so as an example, it comes back up, sellers are like, hey, I dip bought here or whatever, maybe they're underwater and this is the best they think they can do. So they start selling. Well, that means you're selling to someone who now owns it at this level. So if it gets above that level, owners now own it at that level. So if it comes back down to that level, those owners sometimes go, hey, I'll buy some more. So psychologically, that's what creates resistance and support levels is merely the people that buy and sell at these very specific levels. And it's very easy to identify because buyers and sellers tend to buy and sell at the levels that they previously bought and sold at. That's it.
Right.
And literally you can trace this the whole way across. But anyway, yeah, sorry.
Okay. We got another question from John Z. You mentioned that you sell in quarters at 10 and 20% gain. What is your loss percentage threshold for selling? I gotta ask you this in the beginning, but is it 5% loss then sell or more?
Good question. Okay. So and don't get me wrong, I know very successful traders who use percentages, right, to sell. I never do. Percentages, my exit points are always going to be based off the moving average, always. So what do I mean by that is, well, we talked about it for the 200-day. One day closed by the 200-day out. I might be in the very next day again, but out. So more specifically for faster moving averages, like the 20-day, which is what I typically swing trade. Let me bring up a few examples of my actual swing trades so you can see this. I'll bring them up live here for you.
So you're saying going up 2-day confirmation, you're in, and then going out, if it closes underneath, you're out no matter what.
Yeah, so I'll boil it down very quickly, very easily. So for the 200-day moving average, those are for longer term holds. If you're just looking to grow money, basically, that was not growing before. The ideal entry is the cross above the 200-day moving average on a very large cruise ship type stock. Not literally cruise ship stocks, but meaning the behemoth stocks that don't turn on a dime. These are the Boeings of the world. These are the Apples of the world. These are the Facebooks of the world. Okay, here, you want to create a watch list? You know what? This is the best way to create a watch list. Here, let's just do it. We deviated, and I'm sorry for that. You can do exactly what we just talked about and look for beat down stocks, and then you can get your entries faster. But if you wanted an easier, it's not a faster way, it's a slower way of doing so. Go to FinViz. You'll see this weird looking block thing over here. It's called a heat map. Click on it. This brings up your heat map. All this shows is the bigger the block, the bigger the company. If you really wanted to just say, hey, I'm just looking to grow my money over years, choose the biggest companies. Apple. Well, there we go again. I don't know where these ads are coming from. I don't even know if y'all can hear that or not.
Yeah.
But hey, if you're going to use FinViz, you got to put up on that. Okay, there we go. Anyway, so what are some of the ones? Apple, Microsoft, Google, Facebook, Amazon, Tesla. So hey, look, there's your, if you really want a simplistic way to trade, just do that. Hey, I haven't even looked at these, but why don't we do it really quickly? Why don't we look at Microsoft as an example? Here's Microsoft. Well, see, and again, why I don't like these right now is, you're
Way
so,
off.
there's no real good entry point. Meaning you would have bought here in what, 2016, and you would have held it to 2019, 3 years. But this is how you do solid investing. So what I would submit to everyone here, because I know we're getting long in the tooth tonight, and I think maybe we just use the 20, and I'll explain the 20-day rule here in a minute. But I would say this is your number one way of growing your family's wealth conservatively. But when I say conservatively, I'm not talking about bank account conservatively. I mean like in a safe manner, right? In a safe manner. Put the biggest companies on your watch list. Now, most of those companies are well above the 200 days. So it may take months or even a year or two for you to get an entry on these, right? And I'll tell you this, in my opinion, we're within a year or less of seeing some massive pullbacks in the market, anywhere 50, 60, 70% pullbacks in the market. That's a whole nother thing.
It's gonna be epic.
Which is very uncommon. It's super common, actually, every 10 years, but we forget about that. Anyway, so that being said, is just make sure you book this strategy down and log it, log it in the brain box, right? Because this is going to be important. Whether it's Microsoft or let's say you already own these things. Better yet, let's say by happenstance you own some of these things, maybe Facebook, and you're like, wow, I've had a great meteoric rise. When should I get out? I don't really know. Well, you could use the same methodology, right? Couple things with the 200-day moving average you'll notice is, as I talked about the crossing over, also understand that the 200-day moving average acts as a rubber band. If you get too far away from it, you will get snapped back to it. And you'll notice that with every company. You get too far away from it, you get snapped back to it. And we expect that actually not far off from many of these companies. There's a reason the stock market is up. It actually has to do with the devaluation of the US dollar, which actually pushes up the stock market. And it doesn't last forever. But anyway, that's another topic. So then the better question is, okay, so this strategy is probably the best for your long-term investments, but it can take a while for this to set up for you. So in the meantime, what do? That's the 20-day moving average. So whereas the 200-day moving average, it's simple. In on the day it closes above, out the day it closes below. The 20-day moving average is different. You enter 2 consecutive closes above the 20-day moving average. You exit 2 consecutive days the close below the 20-day moving average. So it's not about percentages. I want to answer that question. It's not about taking a 5 or 10% loss. It's about, hey, if it closes under the 20-day moving average twice in a row, I'm out. Now, this, because the 20-day moving average is a very fast moving average, right? It's only 20 days. So this thing gets jerked around. There's some stocks that just do not fit that strategy. So what did I say earlier is you need to find the personality of the stock that this fits for. So as an example, Facebook, again, and I said this earlier, the faster the moving average, the more you're going to get chopped out. But the better profits you can have over the course of time, potentially. What I mean by that is, pick any point in time, like this year. This is 2021. What I would do when I trade the 20-day moving average, I'm more apt to take profit. Oh, truly, I'm more apt to take profit depending on the stock. If it's a small cap stock or a mid cap stock, meaning it can move like crazy, I might not take my first quarter off until I'm 20% higher. If it's a large cap stock, and you can write this down and take it to the bank, like Facebook, Google, Microsoft, when I have 10% gains, I typically take a quarter off. Then if I get a 10% gain from that mark, I'll take another 10% off. And then I'll let the rest of the 50% ride until I close below the 20. So that's how I do it. You can find your own way of doing it. Really what I'm showing you is how to find good entry and exit points. But what I have found works for me also for taking profit. And as I just showed you on my swing trading account, my percentage of wins are 54%, yet it's given me a pretty decent profit curve. And I just want to keep reminding everyone of that, right? This is the profit curve with this terrible, I'm not promoting myself, terrible winning percentage, right? Has given a nice profit curve. Because I take my losses quickly. It's not about a 5, 10, 15, 20% loss. It's under the 20, 2 days in a row, I'm out. And when it's above the 20, you let it ride. So I said that we were going to look at some of my real term examples. Oh, okay. Oh, by the way, if you want to use this strategy, you want to use it on stocks that are moving too. You know, that's kind of fun. So I did want to make note of this, and I'm glad I remembered this, is you want to look for sectors that are moving. How do you do that? Well, you know, there's a couple ways. You can look at stocks that move that day. Like you can go to FinViz and simply use a scanner, say, hey, what stocks moved more than 10% today, right? It'll whittle it down to like one page. But more to the point, I'll just give you one. The cannabis sector, don't get me wrong, I'm not promoting it. It's a hot topic. If you know the cannabis sector, as an example, and I'll literally give you the stocks to watch. Sun W is one of them. I'm going to get here. I'll give you 1, 2, 3. I'll give you 7 stocks to watch. These are fun, but these are not the 200-day. This is the 20-day. Same idea. Keep these on your watch list because these are coming up soon. These are the cannabis sector. Why is it hot again? Because they're talking about it in Congress. If they legalize it nationwide, you're going to have a lot of companies make a lot
Making
of
a
money.
lot of money.
So last time they were talking about it back in February of, as an example, back in February, one of the, and this is going to be true with every stock. So in a sector, when a sector heats up, like EV, electrical vehicles, if you remember earlier this year, EVs were a big thing, not just Tesla, but all the EV companies just go, woo, you know, they all go together, right? So trade the technicals. So earlier, right, cannabis was a hot thing. You typically get a warning ahead of time on these. You get these bumps and then profit taking. And then what happens is you're back above the 20 in at $5. And this thing just soared from $5 within like what, 2 weeks to $30. I mean, come on, right? 600%.
Wow.
I mean, let's just say you got a piece of that. Are you going to be upset that you made 100%? I mean, come on, right? Maybe I just cracked myself up. I don't know. But okay, so what happens here is let's boil this down. Cannabis sector is heating up again, and I'm going to show you. It doesn't look like it, but it is just because we know what's going on in Congress. That's maybe just more of a fundamental thing. But so we're above the 20 here, back here, and when it took off, it's like, oh my gosh, like we're up 600%. First of all, you should be taking profit, right? I mean, the very first day you were already up almost 100%. You could even take a little bit of profit then too. Yes, you'll kick yourself a few days later, but you're not gonna be mad that you made 100%, right? On a piece of it. If you're up 200% the next day, take another quarter off, and then what you do is you let the rest of the 50% ride. But I'll tell you this: if you're up 600%. I would fall victim to taking all my profit off the table, somewhere around the 400, 500, 600%. I would never last to 600%. I would be
Long gone.
right around 400%. I'd be like, well, and then I'd be so angry that I left the rest on the table. But if you're a purist on this, you would have been in here and you would have been out actually right here at around $17 if you're a purist on this. So a couple things though, and this is where the art meets it. So I'm teaching you the purest form of just reading mere moving averages. But I know Pablo talked to you about MACDs, and this is where this starts to come into play. When you have what's called a parabolic move, meaning something that just goes straight up to heaven, it's important to watch the MACD because you watch the MACD and it's not necessarily when it crosses over, because at that point you're already way down here. But when the MACD really diverges and then curls over, that shows you a move is ending. And if that wasn't enough for you, because that's kind of an art form that you have to really work on, though, let me put it this way. Even if you got out where the MACD crossed, you're out at $18 in at 5, you're still doing well, okay? But even if that was not the case, is remember psychology. That's all we're measuring. You went really high, it came really far down. We're still above the 20, so you're like, well, I think I'll hang on to my 50% that I still have. It bounces back up, but when it bounces back up and then comes down, what did it just do? It made a lower high. That's very bearish, because what that tells me is bears sold before it could even make it back to a high. And what they're saying is, oh man, I just want my profit. I just want out. And of course, if you're a purist, so you have multiple things you can operate off of. You can operate off the simplest things. The 200-day moving average, as we talked about, if you're into this type of faster trading, 22 consecutive closes. here's two consecutive closes right here. So you're out at around 17. Yeah, you'll probably be angry that you didn't take, you weren't out at 30. But again, you could have used your judgment when you start to learn candlesticks more too, and you see a candlestick like this, which is called a doji candle, meaning it's shot up, it's shot down, and closed basically where it opened. It's a candlestick that shows indecision. Bulls and bears fought the entire day, and it usually indicates a reversal. So again, that's what the cool thing about technicals, right? Is the more you learn, the more it puts your odds in your favor. But even learning the basic technicals of moving averages tonight, you can have major success. And then you can sharpen up on that success when you start to learn a few other moving technical indicators. So anyway, so Sun W, keep that on watch, because what happened is, of course, this has been below the 20. There's a few caveats here, and I know I feel like I always say there's a caveat, meaning, well, wait a minute, it's above the 20 here. And just how I know how these things go, I'm like, yeah, but you're still so, that's really not the point. The point is simply this: is I'm looking for a period of, what's a sector that's heating up, and we're heating back up. Even if you played this little movement here, you would have been in that $10 or $9, and you could have made some profit because it went up to $10 and $11. You could have pruned some, 10% profits off there. But here we are, we've been now bouncing off the 20, which shows me that it's adhering to it. It's got this major volume shelf right above it. If it breaks above the 20, it has a very strong possibility of doing a squeeze like we've seen. But anyway, that's
Wow.
Sun W. I'll just go quickly through the other ones.
Major
SN
accumulation, huh, John? Like
I'm
when it's
sorry.
like sideways actions, it's like a lot of accumulation as well.
Yeah, we call it price capitulation, meaning the bulls and the bears are kind of saying, yeah, we're not going to sell, and we're kind of waiting to see the buy. It's kind of a waiting period, right? It's just like, let's see what happens. So this is a stock, again, in the weed sector. So it's a little bit more responsive to the 20-day moving average. You'll notice this when it came back under the 20, came back up and tested and failed to the
Rejected.
T. Rejected, meaning it tried but closed below, broke above but closed below, touched to the penny today. This is when I say personality of a stock, this is in the weed sector also. And I like this one even more because it shows me how responsive to the 20 it is. So it shows me I like that. So that's SNDL, another one. And I'm just going to go through these because these are ones you're going to just want to watch. OGI. Also, what you'll notice from the personality is you want to look backwards and see, what is the stock capable of? Is it capable of strong moves? Well, sure enough, this one is. This one from $1.50 to $6. I mean, kind of the same idea, 600-700%, similar to the other ones. They're all going to go in tandem. But again, this is beautiful. This has got a couple of different things going on that I like. It's got what we call a descending resistance line, where it's got a hit. And also, I love the 20 on this one too. I never like the first rebound on a 20. That's a caveat. But what you'll notice here is when it finally gets two consecutive closes, you're in here at 260, and it rides beautifully. And you could have taken some profit. You didn't need to, but if you didn't, you would have been out at around $3 still. Not bad from a percentage point of view. You're making what, I don't know, 18%. Then it rejects off the 20. I love that. It shows me that it's paying attention. Right here, it closes here, but opens the next day right on the 20. That shows me it's really looking at the 20. The traders on this have given it its personality. But the next day, because I'm looking for 2 days, it failed. No buy. Broke above one day, closed below the next day. Today, what was today? Today was a close above.
Yeah.
So tomorrow might be interesting. I really hate putting in new buy orders on Fridays. I really hate that, but I still do. So tomorrow's interesting. And again, because now it's tight, it's trading in a very tight channel. And look at this. It's above the 200-day. I mean, look at that, bouncing off the 200-day and the 20. Now, what did we say earlier? The bigger the moving average, the more weight it carries. So the 200-day has a bigger probability of holding than the 20 being resistance. So I expect this to go up. If you look at the volume shelf, at a minimum, I expect this to go to about 350. That's $1 a share. That percentage-wise, that's quite big. All right. So I won't analyze any more of these because I'm sure I'm boring you all to tears. Here's another one, ACB. Keep that on watch. It adheres to the 20 very well. CRON, only a couple more. Same, exact same. And again, this one has less profit potential. This has only about 100% profit potential. Only.
Yeah.
If you wanted to trade a mega cap weed company, cannabis company, TLRY. It's in the cannabis sector, but it's a major player. So it's like a cruise ship. It still has a lot of ability to go, but the other ones I showed you were more like speedboats. And then the last one is CGC. Again, the only reason I'm going through those is if you're adhering to this 20-day moving average. And don't put big money into this. Remember, there's always opportunity. These things come around all the time, but test it out, right? Put $5 in, $10, $100, $1,000, whatever it is for you. It doesn't even hurt to do $4, right? Just get some experience under your belt, but never put money in that you can't risk losing. How do you know how much that is? Is when you hit the buy button, are you sweating it? If you're sweating it, you put too much in. All right. After you get enough trades under your belt and you're confident and you know your statistics, all of a sudden trading becomes like, yeah, I lost that one. Doesn't feel good, but it's part of the game.
Yeah.
In any way, I'm really long in the tooth. I know we didn't cover even like 3/4 of what I
This
wanted
is
to
awesome,
cover.
John. Yeah,
Thank
we
you,
have to do
John.
this
Yeah,
again.
I think we'll capture all these notes and send them out, and then just we'll work with your schedule, John. I think like maybe even a hands-on session, like a trading group where people are in their accounts. Maybe the next step. I've already asked the group, and they're very interested in that. And that's more like the practical, like doing trades and all of that. But really appreciate it, John. This was awesome, and I was really looking forward to like, what is he going to do as a simple trade? And man, you nailed it. Like this is as very straightforward as you can get from what I've seen in trading.
Well, I appreciate that. I want to show you one thing really quick, and this will be really quickly, just to say, well, how profitable is this strategy? And you'll notice, so I filtered the 20 SMA swing. That's what I call it, right? Because that's the 20 SMA. So we talked about the 200-day, and I'll be very quick, Pablo, I promise. But if you look at this chart, it was only a what was it? It was supposed to be a 1-month challenge. I think it ended up to be a 1.5 months. So look, it was a small account challenge. It was a 10,000, meaning each trade was only max size was $10,000, like max size, right? And again, small account could be smaller, but the point of that is in a month and a half, it went from 0 profit to about 25. So my point is that's 25% profit in a month. And I didn't even do well that month, meaning this is using this strategy in a month and a half, 25%, meaning there were some great winners in there, 40, 50% winners. And I had quite a bit of losers. And last note there is, let's just look at the details on the win-loss ratio. This is why this is so important to track. Look at this. Oh, you're going to love this. I only won 41% of my trades. I've lost more trades. I shouldn't even be showing. This is embarrassing. I lost 60% of my trades and yet had a profit of 25%. All right. So again, it goes back to, you don't have to win the majority of your trades. You just have to trade smart. All right, Pablo, sorry.
No, it's awesome. Great, John. Thank you so much. Thank you all for sticking around, those that stayed till the end, and hope you all have a great night. We'll send out the notes.
Yeah, thank you, John.
All right. Thank you
We'll
all.
talk soon. Yeah, thank you, everyone. It's amazing. See ya.
Thanks, guys.
Bye-bye.